Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Michael Normyle, U.S. economist at Nasdaq. We're going to discuss some of the macro headlines that the market has been contending with as we've seen a reversal in fortune for the bulls here, certainly over the past 5 days. Michael, it's great to see you as always. Welcome back to Trade Talks, and walk us through a brief recap of what you saw in the charts last week.
Right. So in the last week, the major equity indices are up 3 to 4%, but 10-year yields are up about 20 basis points to 4.1%. And so stocks reacted positively to CPI data, some news out of the UK that helped reestablish some fiscal credibility, and some positive earnings commentary too.
Let's take a look at that first with the CPI data, because it's stubbornly staying pretty high here. Do you think that investors have come to terms with it? They've discounted it into their models, and they know that this is something that's going to be a macro headwind for some time here?
Right. We did see a bit of an interesting reaction to the CPI data because CPI came in higher than expected. Headline fell, but not as much as expected. Core rose, but that was higher. It rose more than expected. And we saw core rising, even though core goods inflation has been coming down since February. And that's because core services has been rising. And the weight for core services is about 3 times that of core goods. So that more than offset the decline in core goods inflation. And so that's mostly been driven by housing, even though we've seen signs of disinflation in alternate measures of housing inflation, like home sale prices and newly signed leases, which have been coming down. The problem is that housing CPI, that is a sample of all homes, not just recent transactions. So we had a bit of an unusual situation where markets opened lower following the CPI data, but ended the day about 2 to 3% higher. And that could be because they recognize that these alternate sources or alternate measures of inflation are showing signs of disinflation that should filter into CPI at some point, or perhaps just that inflation's been so high because there's a lot of demand, and that means the economy is still pretty strong.
Yeah, Michael, it's so interesting. You spent a good part of your time in the U.S. as a U.S. economist, but we certainly saw over the past 3 to 4 weeks just how predisposed our markets are to other headlines, and certainly what happened with fiscal policy in the UK, and just how quickly that shift lended to some of the volatility we saw in the market.
Right, and they've been working to address that. So on Friday, the UK Chancellor Kwasi Kwarteng was fired, and he was the person who was in charge of the mini budget that caused all the turmoil in markets about a month ago. And if you remember, the new UK government had a new budget that included £45 billion in unfunded tax cuts, which was thought to be inflationary. So that was happening at the same time that the Bank of England has been trying to bring down too high inflation already. And so that led to markets expecting that the Bank of England would have to hike even more. So bond yields rose. And it got to the point where pension funds were facing collateral calls, which could have led to more selling and yields rising more. But the Bank of England stepped in and kind of stabilized markets. But we have a chart here, a 300-year chart that shows how rare the market response has been, where 2 years ago, 10-year gilt yields were 0, basically. Now they're 4%. And in the few days that followed the release of the mini budget, they rose from 3.5% to 4.5%. So in recent days, they've been trying to undo the damage. That included firing Kwasi Kwarteng on Friday, and then on Monday, his replacement, Jeremy Hunt. He undid nearly all of the tax cuts, and we saw 10-year gilt yields drop about 50 basis points in the past week as they've kind of reestablished some fiscal credibility, and that's helped remove some of the financial instability also that we've seen globally, not just in the UK, which included helping the US markets too.
Yeah, well, I think, Michael, part of the issue is that the market is digesting such fast moves in asset classes that don't typically move like that. Even when you look at mortgage rates here in the U.S., in just about 18 months, you go from high 2s to now we're over 7.2, I believe, is what the print was today in the 30-year mortgage. So I think it's the market being able to digest the velocity of the type of moves that we're seeing. But one bright spot that continues to remain is the consumer, and we're starting to hear this with what's coming out of earnings reports.
Right. So earnings report, they started a little bit slow. A week ago, we were talking about 2.4% earnings growth. Now we're looking at more like 1.3%, but we haven't had the kind of collapse that some had feared. And we also got good commentary out of the Bank of America on the consumer. And that included seeing credit card spending rise 13% year over year, yet delinquencies remain around historic lows. And on top of that, deposit balances are still multiple times what they were before the pandemic. So we see that consumers have cash in the bank, they have a desire to spend, and they make up about 70% of the economy. So it could be that, the recession risk that everyone's been afraid of isn't quite as high as feared, which of course is good for stocks.
Right. All right, Michael, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.